Some of us never took trading too serious until when we came here. That was when we faced a lot of challenges, and we know we should surmount those challenges and then move forward. It got to a point that some people had wanted to give up on trading. But thank God that we came to this platform. Through the help of all our leaders, we've gotten to where we are today. Thank you very much. So like Auntie Bola said, I want to talk on 2 or 3 things here, and then I'll give the floor to another person. I will talk about the break of structure as far as SMC is concerned. The definitions and all that have been done, and I think I believe Auntie Bola had talked about the situation of the market today. We have news after by 1:15 is going to be news, 1:30 is going to be news, and all down there. So let's trade with caution when we get to that time. Then I'm going to talk about a little about change of character and break of structure. Then the supply and demand zone. Then the fair value gap. I want to put that a little, and then we continue. Then first of all, market structure. I'm not defining market structure, but I want to see how we can identify this structure. Personally, sometimes when I want to identify market structure, what I do is let me just do this. Let's watch. I'm going to put a trend line here. Let's search what's the way I identify market structure, and I look for what to do. Some people go to this is some people will identify it by going to maybe like 1 day time frame, some like 1 month time frame. But sometimes, like me, I will go to maybe a month time frame. Some people will go to a 1 week time frame. But like me, I will go to 1 month time frame to see what the market is talking to me, what the market is saying. Then from there, I will now know how to move. 1 month time frame is just like somebody driving a car to an unknown area, and you're using a Google map. You want to use the Google map to navigate your way to where you're going to. So that's why I use a 1 month time frame. This is how I do. Let it pop up. Okay, it has now popped up. This is 1 month on gold. This is 1 month on gold. Then when I get to this point, what I do is I now use my rectangle. I'm talking about market structure, please. So I will use this rectangle to see where the direction of the market is going to. So I will count the last, because every candle you're seeing here is 1 month, 1 month, 1 month, 1 month. All the candles here, 1 month. So what I do is I will count the last the last 4 months, 3 to 4 months. We have one here. So we have this candle week here. We have this candle week here, and then this is one month. This is the second month. And this is the last month. And we know that this is a July candle. This is June candle. This is May candle, and this is April candle. So what I do is I will come here to this week, drop my rectangle, and then I will mark like this. I will mark like this. After doing that, I will now go and pick my horizontal line, keep at where the price is, keep at where the price, this is where the price is. That's where the price is. So if you look at what is happening here, this box here, this rectangle here, this side where the price is closer to the top side. You know, remember I marked all the wick is closer to where we have this price. So I now know that the market is going upward. So I will now look for the opportunity to buy. That is an opportunity to buy. So that's what I'm saying today. Then this side, if supposing it was here, it would have been a sale opportunity to sell. If it was here, it would have been a ranging market. But we are seeing that it's closer to this side. So after establishing that, I now delete this. I now delete this. Please, I'm talking about market structure. The trend of the market. So I now switch over to a lower time frame. You can go to 1 week time frame. Because I use time frame to look at it. You can go to 1 week time frame. We can now see what the market is telling us in 1 week time frame. 1 week time frame. Or if I don't see a place to enter at 1 month, what I will do is I will come to 1 week. Now that I have seen way to what I'm looking for at 1 month, I will now come to 1 week. I mean, I will leave 1 week and go to one day time frame. So what happens in okay, so I will come to 1 day time frame to spot to look at the market. So from 1 day time frame now, we can see that the market is beginning to get bullish, to go up now. Beginning to get bullish. So I now go to 4-hour time frame. 4-hour time frame. Now we can now look at the trend. If I should do like this, if I should pick a trend line and pick my drawing like this. So the law of trend line is that it must touch 2 or more candles. It has touched 2 candles now. So the market is bullish. Now I can switch over to the next time frame, which is 1-hour time frame. And if I still take a trend line, I will also see that the market is moving upward. The market is moving upward. As touched here, it's moving upward. So what I would do is to look for opportunity to see where I can buy. So the market is moving upward. So that is how to identify that's a trend line. So we now see the trend of the market, because if you trade against the trend of the market, definitely is going to be complete loss. So that's why the first thing is to know the trend of the market. So now we have established the trend of this market using 1 month, and we come to a day time frame, 4 hours, and then a 1-hour time frame. It has still given us the same thing, that market is bullish. So we come to this point. So that's how we can get a trend. That's how we can. That's the market, the trend. So it's an uptrend. Now we can establish that this is an uptrend, and the same thing is done to establish a downtrend. We have 3 types of trends. This is the same thing is done to establish a downtrend. So after we have gotten that, we now go to a break of structure. We talk about a break of structure. Let me delete this line, this trend. A break of structure. So let me fold this. I want to fold it so that we can. Let me take it to a higher time frame for 4 hours. For us to be able to appreciate the market, I think the higher time frame, the more higher the time frame, the more we appreciate the market and its movement. So I now take it like this. I'm using phone, please don't mind me. I hope everybody can see. Please, I'm using phone. Please. Sometimes they may be smaller. So all right.
Please, that's an advantage for everybody using phone.
Oh yes, sir. Thank you very much. So this is it. I'm bringing it like this. So if you look at this market here, let me make it a little bigger so that we can see. All right. So if you look at this market here, I want us to note this word. Please, I'm going to make use of what we call zone, Z-O-N-E, zone. Please, I'm going to make use of the word zone, please. A zone, I think I can define a zone a little. A zone is a place where market reacts to or reverses from. A zone is a place where market reacts to or reverses from. That's what we call a zone. Or you can say zones are those visible and major places where markets react to or reverse from. Those are zones. Market does not just go in one direction. No, market is like somebody traveling from one place to another. Sometimes you're not using your own vehicle. In fact, one way to another. A road is not just straight. You go to get to a junction. They say go to right. You now enter right. During that, going to right, there's going to be a reaction. There must be a reaction. if you're going to where you have a circles, turning that circles is the same thing that market does. There's going to be a reaction at that point, or there's going to be a reversal. So you go right, there's a reaction there. Then you go to the next street, there's going to be a bend. That bend is a reaction. You go here, there's going to be a bend. That bend is a reaction. If you're using your own vehicle to drive. But if you're not using your own vehicle if you go to a long distance, possibly a distance that can take up to, you can enter like up to 3-4 vehicles to get there. You move from where you are to another place, you alight there, then pick another vehicle from that place to another one, you alight there, pick another vehicle to another. That is a zone. A zone is like you shooting a vehicle, a bullet to what do they call it? A bulletproof car. When you hit, it's going to come back to you. That's how a zone is. I think I've given some examples of zone, please. So I'm using that word zones. So when we come here, we have seen zone here. Market does not go in one direction. It goes from one zone to the other. That's why some people, they lose money when there's going to be a reaction. If somebody enters a trade and there's going to be a reaction, sometimes they cut the trade. When there is a reaction, the reaction is that a zone has bounced, meaning the market has bounced, meaning bounces at that particular zone. Probably it is reversing, going back, because there's a hit. At that hit, market is going to come back because it can't just go like that. Market is going to hit. As it is hitting and it is coming down, somebody will say, I'm losing. So you're seeing rate now. And we cut off the trade. When cutting off the trade, and probably the market will now go back and pass that zone to another zone that is going to. So some people will now lose money. And they say, if I had known, I think I wouldn't have done that. But they had already done that. So please let us understand this now, that those zones, there must always be a reaction when it gets to zones. There must always be a reaction when it gets to zones. And these zones can be found in all the time frames. You can find it in one day time frame, you can find it in a 4-hour time frame, you can find it in a 1-hour time frame, and so on and so forth. You can find those zones there. So like what we have here, we have a zone here. I'm going to use I will use 2 tools here to bring up this here. The first tool I'm going to use is going to be, let me use, we have a zone here. We have a zone here. All right, I just want to map them. We have a zone there. And we also have a zone here. We have a zone here. Where the price is a very big zone. You can see there's a zone here at where the price is. So that's why the price is, making all the shagara. We also have a zone here. We also have there's a zone here. There's a zone here. Look at this place here. Look at this place. There's a zone here. And so on and so on and so on and so on and so on. So now let me erase this and start saying something here. What I want to say here is that the price now came to this zone. Let me expand it a little more. Please. All right. I've expanded it. Let's, all right. So there's a zone here. Let me use my horizontal line. Look at this zone here. Price came here. Initially, it came here and went back. Came there and went back. Came back to this place. And then we had this sell. And then it went down here. And then came up here. So I'm talking about break of structure now. I'm at break of structure. And probably a change of character. A break of structure. So there's a structure here, a very big structure at this place. As a price comes here, some people, for fear of when they saw this particular candle that came up here, this new candle here that came up, for fear of missing out, they say, it has broken here, and they just want to rush it to take a buy. When they take a buy and the market starts retracing, and they will lose. Or sometimes they will now run out of the market, or something will just happen. So what happens here is we have a zone here. There's a structure there. There's a structure at that place. Now, when we come to okay, there's a structure there. Because we don't have time, let me combine three things together: break of structure, change of character, and supply and demand. I think I want to combine the three of them so that I will now round up this. We have only 30 minutes, sorry. Okay, right. Now this is I would call this a demand zone. I will call this zone a demand zone. This is a supply zone here. I'll call this a supply zone. Supply zone. This is a supply zone. Now, why do we call it a supply zone? Because I forgot to put one word. You know, in a trend line, an upper trend is when a price keeps on breaking a higher high, creating another lower low, and then breaks up a higher high, and that's how we call a bullish trend. And the same thing is applicable to a bearish trend. When a price keeps breaking higher low, when it keeps breaking higher low, when it keeps breaking, lower low, keeps breaking lower low, breaking lower lows, that's what we call that's what we can identify. But like this one, it is breaking higher highs, like what we have seen in so many of them here. It broke here. This was a high that it had broke this one. Please look at where to have this. I'm using this thing blue here, inner blue here. That's what I'm using. It broke this one, and then it is now here. All right, it is now there. So now demand zone is supply zone. When we come to a zone like this, so the first thing that we look up to in a zone, demand, a supply zone, either a supply or a demand zone, is a candle, a long big candle, that is bigger than sometimes like 2 times or more than 2 times or 3 times or 4 times than the previous candle. I think I should start with a demand zone. Let me start with demand zone. For instance, let's come down here. This is a demand zone. We'll call this a demand zone. Now, this market broke this with a bigger candle here. With this candle, let me use rectangle to mark this. Let me use rectangle to mark this. Then delete this one. All right. This market used a bigger candle here to break this zone. He used a bigger candle here to break this very zone, to break this particular place. So what we look for is, the first thing we look for is the long candle. And that candle must be 2 times, 3 times, 4 times bigger than the previous candle. 2 times, 3 times, 4 times bigger than the previous candle. That's when we can say that we are there's a break of the zone has been, there's a break of structure. For instance, like what we had here in this place, let me delete here. Like what we had here. All right. Like what we had here. This zone was broken. As this candle broke this zone. Let me use my rectangle to map this zone, please. All right. All right. So as soon as this candle broke this zone, you can see that this candle is a very long candle. It is 2 times longer, more than this previous candle here. More than this previous candle here. Is like 1, 2, 3, possibly 4 candles. 1, 2, 3, possibly 4 candles. Then after that, we check the next candle. The next candle that followed it. The next candle that followed it. So the next candle that followed it is this particular candle here. So we can now see this particular candle. That's the next candle that followed it. That's the next candle that followed this zone. And then what we do is to draw our own zone. So let me delete this one and pick up another one. What we do is to delete that particular, to draw a zone here. So I now pick up this, my rectangle, and draw this from here to here, from here to here. So this is what I do. I draw to these points and shift it here. All right. All right. All right. So that's what I've done. So the first instance, after that had happened, you can now see that the price went up here. Sorry, let me delete this. The price went up here and came down to this particular zone, inside this zone. Look at where I drew here, the end of this wick candle and the end of this other wick candle, that this particular momentum candle broke. The price went up here and came down. Now, this is what I will call liquidity sweep. This is what I will call a liquidity sweep. This one here, like this one. So it went up here, came down here, and then it now sweep liquidity here. Now look at it, what happened here again. The price equally went down. When it went down, it came to this zone and respected this zone and then went up and went up. Then let's look for how we can see another zone. All right. Let me see where I can see another zone, because we are going to see how we can trade today. Going to see how we can trade today. So all right. So the next one is, let me reduce this to 1 hour time frame, please. All right, let me see if I can find what I'm looking for in 1 hour time frame. This is 1 hour time frame. This is 1 hour time frame. All right, so this is our structure here. We can now look at our structure is here. This market is not able to break this zone. This is 1 hour time frame. It's not able to break this zone. Where is the zone coming from? Let me pick a rectangle. Where is the zone coming from? The zone is coming from this very direction. It's coming from here. This is where the zone is coming from. I would cut it like this. Bring all this together. All right. So that is it. This market is not able to break this zone. Therefore, we may have a possible sell. Even as I'm talking now, we may have a possible sell from that direction down. It's not able. That is our supply zone. It is not able to break that zone. So we might have a possible reversal to this very zone down to the next zone, and then we can now switch it to 4 hour time frames. Say we can pick the next zone that can say the market will sell to. All right. So a zone close to where the price is this one. This is a zone close to where the price is. So we might possibly see a reversal to this very zone. Might possibly see a reversal to that zone. Even as I'm talking, it's going to sell. So we'll see a reversal to that zone. But if the market peradventure breaks this zone, we don't just jump into the market. What we do, there are two candlesticks that I normally like. There are two candlesticks that I normally like when I see them in a zone. We call them pin bar and an engulfer. Pin bar and an engulfer. Now, pin bar, anytime we see a pin bar shows, and is a doji anyway, but that doji, we call it a pin bar. Anytime we see a pin bar inside a zone, that indicates that there's a possible reversal. So before I enter any trade, the first thing I do is to look at that particular candle inside that zone, pin bar. So how does pin bar look like? Pin bar is any candle that has a long tail and a small body. A long tail and a small body. I think I will call this one is not long enough. This one is not long enough. Okay, look at this one. Look at this one. This is a pin bar. This is a pin bar here. This is a pin bar here. Yeah, that's a pin bar. Or if you look at this market, it has rejected here several times, rejected here, came down here, it is still rejecting here. So until we see, so that's how we can possibly have use one of the candles that we can use and have an entry into the market. So this market, like now, has come to our demand zone. So it is possibly going to sell and come down here. I don't know, maybe our chairman will give us a better trade. Will give us a better trade. So let me delete all this. Please, sir, how many minutes do I have more? Please, how many
5 more minutes, sir.
Sir, what?
5 more minutes. Please start sending in your questions on the chat. Please, everybody.
Okay.
Hello, Mr. Imeakpan.
Yes, sir.
Mr. Akpan.
Yes, sir. I'm answering
Okay.
you, sir.
Yeah, good one. That's a good one. Everyone on the call would have seen that trade based on what we have been teaching and what we have shared this morning. Everybody would have seen that trade and known that that's a good place to have taken that trade. But I think we were already in a sell at around that zone. That sell is in profit now for those who still held it. Ezekiel, did you take that sell?
No, sir. No, sir.
Okay, so because Mr. Akpan was asking chairman to call trade. Based on what you have taught now and what we have been learning, I expect everybody on this call to know that as at the time, okay, Juliet, that's good. To know that as at the time price came back to that zone, even based on just your analysis here, everybody should know what to do. They should not be waiting for chairman to call, because that's the essence of these practicals. That's why we say practical application. The essence is to get everybody to the point where they can execute trades on their own with or without any somebody telling them buy here or sell here. So that is fine.
Okay, sir. Thank you very much, sir. So, like I said, when you see a pin bar,
hold on, just 1 second. Somebody asked a question. He said the price did not get to 33.25. That's correct. Colonel, if you understand what Mr. Akpan was explaining, is a zone. That zone, that price says 33.25 to 33.30. 33.25 to 33.30, meaning you can take the trade from 33.30 to 33.25. Anywhere within that is a zone. That's what it means. Go ahead, Colonel.
All right, sir. Thank you very much.
Go ahead, Mr. Akpan.
Okay, thank you very much, sir. Please note this, what I want to say here. Before you enter a trade, like Sir Chairman just said, I talked about a pin bar. Please take pin bar into so much consideration. This is a pin bar. When you have a long tail in a zone, after you have marked your zone, a zone is a place that a price has reacted. Now, we have a supply zone and a demand zone, where a price is rejected over and over and over, 2, 3, 4 times. Probably you see a pin bar at that particular point. Please, that is your supply zone. When you get to that place, don't enter a trade for a buy yet. Hold on. Don't enter a trade for a buy. Hold on. Now, let me bring this up. Let me keep this as an example. Let me keep this as an example. Don't enter a trade. Now take your rectangle, mark that zone. Mark that zone. You can take it to this level, like you can take it here, for instance here, so you know what you're doing. Like that point. Take your rectangle, mark that zone. Now, if peradventure this price breaks this place, if this price breaks this place, let me not use that particular one. Let me use this one. Let me use this tool. I think I used my part here. Yeah. If this price breaks away from this place, you will see something like this. If peradventure it breaks away from this, you will see something like this. It will go up here, comes back here. Definitely has to retest. It must retest this one. It cannot just go. Sometimes it may be a pullback, it may pull back. If you're using 15 minutes, you're going to see it come back in 15 minutes, come back, come back, come back. It may not form another candle, but it will come back. Probably come back to that zone and then you see red again, and then goes back. Probably come back again. Then when it goes off this trend, this particular zone, you now enter. How will you see it come back, that break that zone? This is how it's going to be. This is how it's going to be. Sorry, let me delete this first. This is how it's going to be. You will see a price like something like this come up. It will break here. When it breaks here and goes up like this, probably comes down, or it may not go that far. Sorry, my hand just went up. It may not go that far. Sometimes it comes here. Just hold on. Wait for what is going to happen. Sometimes it can even come here and then goes back. Hold on. The next time it comes here and doesn't enter this again, that will tell you that that particular zone is broken. Sometimes it doesn't come in again, and then you see something like this, PM. That's how the market will move. So when you observe it, and then if as it breaks, you're going to see a momentum candle. With this momentum candle, some people that are so expert and people that use big money, that's why you see somebody like Joe Arias will tell you buy, buy, buy. When you just sometimes you're looking at the sale, he has bigger money that can contain his whatever is going to happen. So you don't enter as you come here. You don't just the market has come here, has reached you. Let me enter. Fear of missing out. You now run in and enter. No, don't do it. Don't do it. So this market already, we have seen a pin bar. Please, I want us to note it. This is a pin bar here that showed a serious rejection in this market. So when you see a pin bar like this in a zone, make sure you mark your zone. If you don't mark that zone, like I never studied, I did not study about SMC. In fact, it is this AkashX that has made me to study SMC. So from all the study I have studied, day before yesterday and yesterday, I was on it from morning till night. I just knew all the summary in summary. I just saw some of this summary. When you see this pin bar here, when you see a pin bar in this zone, know that something is going to happen. Suspect that something is going to happen. So wait, hold on. Trading is patience. If you're not patient, you're going to waste your money. You will lose your money. But if you're patient, definitely one nice trade that you have in a day can solve the whole problem of 1 week, running around. Or the 2 nice trade in a week, 3 in a week. So this is a pin bar. This pin bar really showed that. And after this pin bar, you saw this candle here. This engulfing candle. Engulfing can be red, it can be green candle, it can be a sell, or it can be a buy candle. So we saw that, and the thing went back and then came down and then went back. You see, this is a reaction, a serious rejection here. That's why we said it's going to sell. We placed the sell, and everybody saw it. So the last but not the least is our fair value. Please let me talk about the fair value, and then I close. Fair value, like we all understand about our fair value. Fair value is an imbalance. We all understand that, and it has to happen in 3 candles. We have 3 candles, like what we have here. These are 3 candles. I want to show us. There are 3 candles here. This is number 1. There's a small candle here. You can see the small candle inside here. That's a small candle. And then we have this big one coming down here. This big candle here. All right. And then we have another candle here. Another candle here. I think I would call this, would take that to be a fair value. Or let me look at another one down here. Let me look at another one down here. So okay. All right. I think I've seen this one here. Okay, let me go to where we have the present price. All right, let me look at this one here. Use and explain a little thing. All right, so we have this here, this candle here, this small candle inside here. Have this candle, this small candle inside here, and then we have this one here. So a point of imbalance is between here, where we have this one here. Look at this candle wick here. That's a point of imbalance. That's one, and then this is another point of imbalance. This is where this candle ended. That's another point of imbalance. Another point of imbalance. All right. So in between here in between here, all right, here and here, that's where the price will always come back to. That's where the price will always come back to. You can now see now, where you have the last week here, the week of this particular candle here, that is the imbalance here, between here and here. This is where I think we can see this blue. This small blue is what I'm using in place. I don't have a cursor. This my thing. This is where, this is a balance, this is here. And then we have this one, the candle that gave way to the move, the big move. This is a smaller candle. Then they hit the tail of that candle before the move started. Not the upper side of place, the lower side before the sale started. If it was a buy, then we pick up the upper side. But since it's a sale, we pick up the lower side. Between here and here is where we have the imbalance. Therefore, the market will have to fill that gap. So you can now see what is happening here. The market has decided to fill up this gap. It would have sold more. There would have been more sales, but no, the market had to come back and refill that gap. Now it has filled this gap to these particular points. It has filled this gap to this particular point where it left a gap. So I think that should teach us another lesson. That should also take us to remembrance when we talk about supply zone. This gap, there was a gap that was created at this particular point. That is your zone. That's your zone. That's where we mark our zone, because there was a gap that was created at this place. And then there's a gap equally created here. So when the price came down here, it had to come back to fill this particular gap. So as it has now reached this place, that's when the market will now make a simple sale or a real sale. It will now make a real sale. It will start selling. So that is what tells us that the market is going to sell, because it does not like creating imbalance. So the imbalance has now been filled. You can see all these candles here. They are filling the imbalance that this particular momentum candle had created. So it has now filled this imbalance. Now that it has filled this imbalance, that's when the market will now begin to sell gently as a gentleman, go down, go down, go down, because the imbalance has been filled up. With this, I think I'm able to do a little justice. I want to learn from my leaders. Thank you very much. If there's any question, let's attend to it, please. Thank you very much.
Okay. Amazing. Okay.
No, Ezekiel, go on. Go on then. Auntie Shampeba, are you here? Because I can't see you. If you're here, can you please raise your hand?
Yes, sir.
Okay, fantastic. So Ezekiel, Auntie Shampeba, you can take over. Ezekiel, Auntie Shampeba. Okay. Well, let's know if there are questions first. Before Auntie Shampeba comes on, let's know if there are questions first. Are there questions?
Effectively bring out of this level. Remember that I've explained this before now. I have showed this for some time. I started talking about that this market will push up from here.
Sorry, was that a question?
Questions.
Okay, please be typing your questions so that Auntie Shampepe can take it away. Type your questions. So as soon as Auntie Shampepe rounds up, then Mr. Imeakman, thank you so much. Please celebrate him with 111 as Auntie Shampepe takes over, please.
Amazing, 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 amazing. Thank you so much, Dr. Akpan. Wonderful session. We all enjoyed this amazing session. Guys, let's celebrate him again. Let's keep celebrating him. If you know you gained value, let's celebrate Dr. Akpan. Let's celebrate Dr. Akpan. Dr. Akpan, you did justice to this. I'm super excited. I'm super proud of you. Thank you for doing justice to this presentation.
Learning from you, ma.
Super proud of you. Thank you so much. Good morning, everyone on the call. Super excited to be having you all on the call. I guess we're all learning. I hope we're all learning. Let's be patient with the learning process. If we can hone our skills. Mr. Ezike, please, can you make me the co-host?
I did that already. Good morning, ma.
Okay, thank you so much. Dr. Akpan, please unshare your screen. Okay.
Yeah, I've done that.
Okay. Thank you so much for all you guys are doing. If you can all see, by the time we keep honing our skills like this, before you know, we get like 50 to 100 persons in Wealth Hub that are calling trades. So this morning again, I'll be going back to risk management. Because if you agree with me, risk management is a strategy on its own. And the only way that we can get our people to do the right thing is to keep teaching them risk management, because we have more people that are being signed up daily. So they need to know that risk management is also a strategy. I'll be going ahead to share my screen now. Risk management is also a strategy. If you can take proper risk in the market, if you can trade with a good risk management, you can stay longer in the market. You know, why we're doing these risk management classes every day now is because of the compounding that is going on. So if you can see my slides, drop 222 on the chat box. Let me know that you can see my slides. 222, let me know you can see my slide. So in forex trading, if you want to stay long in the market, you must have a proper risk management. You know, whenever you take your trade, you must make sure that your risk management is tight. Like I always say, risk management is a strategy on its own. So I'll be talking about risk management in forex trading, you know, as a key to success. If you want to be successful, you need to check your risk management. Don't over leverage the market. Don't over leverage the market, because if the market goes against you, you're going to lose everything. But if you keep your risk management tight, you can always come back and play again. You know, the one good thing about this market is when you keep, you know, when you're able to protect your capital, you can come back and trade again. But when you blow everything in the market, you have to start looking for money to trade. And it's usually very frustrating. So effective risk management is crucial in forex trading to minimize losses and maximize gains. You know, sometimes if you take a proper lot on a trade, you know, no matter how the trade goes against you, you know, you're able to hold the position. It will still come back and, you know, you take profit. But if you over leverage the market, before it gets to a certain point, it will take everything in the market. So what is risk management? Risk management involves identifying, assessing, and mitigating potential risk in forex trading. It is essential to understand that risk is inherent in trading. Like we all know, that is why you must have a proper risk management, you know, and managing it can make a significant difference in your trading performance. So for me, the first strategy in forex market is risk management, because no matter how you know charts, no matter how you know how to analyze the market, if you're not entering the market with the proper risk, you will keep losing, you keep giving the markets all your monies until the day you tell yourself that, you know, risk management, you know, is a strategy. I want to master the strategy of risk, managing risk in the market. That is when you have started trading. Because sometimes we take, you know, crazy lot sizes, it goes our way, but it can't continue going your way. You can't continue going your way, because the market, you know, at times the market will hit you so bad, it will look as if the brokers are watching you. It's just psychology that is playing. Psychology of the mind is playing. Psychology is playing out. So you must enter the market, you know, always trade right. You know, when you're taking crazy lot sizes, Lamborghini lot sizes, Maitama house lot sizes, those are the names I call them. So when you're taking all those lot sizes, the day it goes against you, you know, it's two things now. You either go home or you go big. Either take you back to your village, or it takes you, if you're taking Maitama lot size and the market goes against you, it will take you to either Karo or Nyanya, you know, outskirts, it will take you outskirts of the town. So we must make sure that we put our proper risk management in check. So key components of risk management, we have position sizes, that's the lot size. You know, you determine the appropriate trade size to limit potential losses. Like somebody that has $100 account and is taking 0.5, 0.10. Any small movement, that money is gone, and you know, you just dash the market your money. And the market will continue, the market will go on as if nothing happened, because we are just retail traders. You know, we have the big boys that come in with billions of dollars. You know, just one pip like this, they are out of the market. Some just one pip that year, they won't even bother trading. So those are the people we are trading against. So with your $100, you should be able to trade smart. Like I always say, smart people trade Forex. If you're smart, you trade Forex. So any calculation that you are doing in this market, it should be a smart move. So, and stop losses, I will still emphasize, let's always put our stop losses. Because when you put your stop losses, it helps you to, you know, it helps you to control your loss in the market, your lessons in the market. So you see, like this compounding that we are on, always put your stop losses, so that when the market goes against us and takes us out, we know that, okay, this is certain percentage that the market has taken from us. When the market is stable, we are going to make it. Risk reward ratio, you know, just establish a favorable risk reward ratio to ensure potential gains, you know, or outweigh potential losses, to outweigh potential losses. So you know your own risk to reward. You know, as we are learning this strategy now, as we are trying to master the smart money concept, market structure, you know the key positions, you know your key levels where you expect the market to move, either up or down. You know where it's supposed to move, and you know your risk appetite. Okay, you know that the market is going to get to, let's say this market is going to do 100 pips. You can decide to take your 50 pips and go out of the market. You mustn't wait to take your 100 pips, because sometimes after analyzing, we have other factors that will come, sentiments, technical, news, you know, a lot of things might play out and it will not get there. But the most important thing, because you're smart enough, you've taken just, you know, just certain pips from the market and you left the market. So leverage, you must always leverage carefully. Don't expose your account. Don't expose your account. You know, most times people want to learn from their own experience, but I tell them that because of the mentors you have, because they've gone ahead of you, they've made certain mistakes. That is why we keep hammering on all of these things. That is why every time you hear us hammering on all of these things, because we believe that if you listen to instructions, if you're teachable and coachable, you can minimize taking lessons, you know, just because you're learning from other people's experiences. But some people just want to, you know, experience it themselves. They'll tell you that experience is the best teacher. I don't think experience is the best teacher. You can learn from other people's experiences and not get your fingers burnt. So you set clear trading goals. You know, I talked about trading goals when we did trading plan. You must set your trading goals for this compounding, we have our goals set already. Once you hit 10% a day, leave the market. Yesterday, you guys can see what gold was doing. It will take everything that it has given you. Let's be disciplined. If you want to win in this market, you must be disciplined. If you're not disciplined, the market will teach you. It will enforce discipline in you. Let's be disciplined. The day you start treating Forex as a business, it will pay you. If you're treating it as gamble, you keep losing money from this market. You know, you monitor and adjust your risk management strategy regularly. You know, it's a strategy. So while you're trading, you always monitor your trade, adjust, you know, stay informed about market conditions and economic events. The market keeps upgrading every day. So we must stay informed. You know, you stay informed, you listen to the news, you check the news, you check what the market is doing so that you can be informed, you know, and stop over trading. Like we talked about compounding, you know, everything that we're doing this period is about the compounding. So stop over trading. Once the first trade has given you 10%, no matter how many trades are being called out, go and trade it on your Profem account, go and trade it on your other account. But this one, for the purpose of compounding, once you hit your 10% in a day, don't bother taking other trades on it. So that's discipline. You must stay disciplined. And consequences of poor risk management, significant losses, you know, and potential account depletion. Your account will keep depleting, always depleting, you know, emotional stress and impulsive decision making. You all agree with me that whenever we lose money from the market, we take lessons. That day, you know, you don't just feel all right. You just feel as if something is wrong with you. You know, you're just mentally down, you're not happy because you take lessons from the market. So we can minimize all of this. You know, lack of trading discipline and performance, poor performance. So you must be disciplined. If you want to make it in this market, you must be disciplined. You know, I have a mentor that told me that he deleted his MetaTrader 4 from his phone, his MetaTrader 4 and 5 from his phone, because whenever he sees a setup, he is tempted to trade on his phone. But since he left his MetaTrader 4 and 5 on his laptop, before he will run to his laptop, the stress of running to his laptop to take trade, you know, allowed the trade to pass. So if not, any trade setup he sees, lack of discipline, he just keep taking those trades because he's on his phone. You know, your phone, you just open and you tap, you've taken the trade. But your laptop, it will take you time. You know, you even get tired, you know, you just feel, oh, I let it go. So if you know that your phone is going to put you into problem, if you know that you cannot discipline yourself, delete your MetaTrader 4 and 5 from your phone. That's discipline. If you know that you cannot stay, you know, away from some trades, any trades you see, we can't be jumping in and out of trades. You can't be taking trades like that. You know, anyone that comes, you pick it. Toothpick, you just keep picking them. No, you can't do that. You won't make money because you make the money and you lose it. So in conclusion, proper risk management is essential for successful Forex trading. You know, by understanding and implementing effective risk management strategies, you can minimize losses and minimize gains. Remember to stay disciplined, informed, and adaptable to changing market conditions. So I want to wish every one of us a successful journey. I want to wish all of us a happy compounding period. So let's stay disciplined, let's stay focused, let's not get distracted. And at the end, I know that God will always honor his words. Thank you so much, sir. If you can hear me, take it away from me back, sir.
Thank you very much.
Pepe, thank you so much. Everybody, please put 222 for her. I hope you heard that advice and you're going to implement it. Today's trade, I've it's come back to profit couple of times. This price looks like it's going to drop, but for me, I don't like the setting, the way the price is behaving today. So when you're in a trade like this and it is behaving this way, what you do, if you took the trade, once it comes back to your entry point, which gives you break even, just close that trade. Once it comes down to your entry point, which gives you break even, just close that trade. So while we're on this call, this trade has come back to our entry over 3 times. And I hope that, okay, please, let's go ahead and stop the recording. Once we're done with trainings, let's stop recording, because at times we might not even realize it and we just go ahead doing our own discussion.